So this is going to be essentially a response video to another prominent financial YouTuber and content creator named Richard Fang, who I want to make clear I'm a supporter of his channel and I think he does great work and puts out solid content. He dropped a video today actually around a topic that I'm going to link the video down below that I want to give a full out response to, because I believe there's two sides to the coin of how he phrased and brought that content to his broad audience. And for any of you that may cross his path and see his video or run across his content, follow his channel and come across mine, as a financial professional and a banking professional as well, as he also retired from being, I want to give both sides of context and give you guys some real gems on how to maximize relationship banking. Because in his video, he basically give a negative connotation around banking and relationship banking. And I want to dispel a little bit of that and give at least the other side of the coin, not saying what he said wasn't true to some degree, but I want to give a broader context. And I'm going to try to do that in the shortest video possible. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like this video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So I'm going to breeze through the topics that he covered because, again, I don't want this to go too long and I could talk all day on the subject. The first thing that he pointed out was how banks make money, which is, in the general sense, when it comes to consumer banking, is interest income and non-interest income, or also known as fee income. Interest income is pretty obvious. Deposits put in by consumers, us, in banks, are lent out to other consumers, like us again, are usually 7, 10 times, 12 times fold of the deposit put in. So basically, if you put $1,000 in a bank, many times banks are able to lend $8, 10, or $12,000 out on that same money, and they earn interest on every time they lend that money out. So they make a ton of money from interest income. The next thing he broke down was non-interest or fee-based income, service fees, ATM fees, NSF fees, so on and so forth. This form of income is, as you already can tell, it's around providing the service for you, and or if you make any financial mistakes that cost them money or something of that fashion. So when you overdraw your account, you're basically borrowing the bank's money and they're charging you a fee for that, right? For instance, hopefully that part is clear for everybody who's watching so far. The next thing he broke down after he broke down how banks make money is how to avoid them keeping you broke. So this was the interesting part. The first point he covered was keep excess deposits out of the bank. So meaning that whatever you don't need to spend to pay bills and whatever you don't need for a 3 to 6 month emergency fund, get it out of the bank and put it into investments. I'm going to push back on this some. I am enormous on relationship banking. I'm a little biased. I'm a licensed banker, but that having been said, I'm also speaking from as a banking client, not only as a banking professional, but a banking client. I'm also speaking from people who I know who are financially successful. They have very strong banking relationships. Now, I'm going to co-sign the fact that he's right. You don't want a bunch, if you have this kind of money, you don't want a bunch of excess income sitting in the bank doing absolutely nothing. I agree 100% with him with that. Where I'm going to push back or at least expand on his point, maybe to be more respectful, is you have to start out your financial journey in most cases maximizing your relationship banking. That's why it's in the intro in my whole little spiel starting my videos, because the bank is where almost every dollar you earn and push out is going to flow through. And that bank relationship is going to be the efficiency of you receiving money, the efficiency of you spending money, the efficiency of you investing money, saving, so on and so forth. The work your dollar does, the bank is going to be very influential on the efficiency of that work. So you having strong bank balances and strong banking relationships, at least for a period of time strategically, is a good move. So what does this mean? Besides spending the money you need for bills and besides the emergency fund he mentioned, the next thing that's important that I'm going to support is you need to have excess reserves in order to strengthen your relationship with that bank, because the true asset to that banking relationship for you as a consumer to go out and make the money that the type of money the bank is making is to effectively borrow from the bank. And in order to effectively borrow from the bank at a high level, you have to have strong deposits and a strong banking relationship, strong cash flow coming in. You cannot leave your bank account bone dry and expect the bank to turn around and lend you 5 and 6 figures or 7 figures worth of money in a short span of time. It's just not likely to happen. Your credit score alone won't get that done. The bank is going to want to see full out banking activity, full out financial activity, and they can see that when you have strong bank deposits with them. So if you want to turn around and make the relationship fruitful between you and your bank, keeping excess cash in there strategically is a great idea for a period of time until you can get enough data points with that bank to make them feel comfortable to lend money out to you at a high level without you having to keep deposits in. That time frame takes time. Next point, stop financing liabilities like auto loans, RVs, boat loans, etc. That was his take. Personal loans, unsecured loans. He was encouraging people to stop borrowing money for those reasons and only borrow to invest. I'm going to kick back again. He's 100% right that you need to be responsible with the money you're borrowing and stop funding liabilities, generally speaking. That having been said, when you go to buy, because he's referring to like investing in real estate, borrowing money from the bank to invest in real estate. As a licensed lender, I'm going to drop the info in the video as well and a link in the description as well. But as a licensed mortgage loan originator, I'm going to tell you as a bank professional, when you go to apply for a mortgage loan, if you don't have enough data points on your credit report, you can't get approved for a home loan. Even if you have a high score, let's just say you have a couple credit cards and a couple student loans on there, and you know, if you have a 700 plus, 740 plus credit score, but you only have 2 or 3 trade lines on your account, at the end of the day, your likelihood of getting approved for not only a mortgage loan, but especially an investment loan where they're even more strict with underwriting from the bank. And you want it from the bank because they're the best terms and the best rates. They're better than private money in a lot of cases, better than hard money when it comes to terms and rates. So how do you get the data points you need to qualify for a loan that allows you to invest in real estate like he's encouraging? You need data points. What are data points? Auto loans, personal loans, unsecured loans. You have to show ways to effectively borrow on smaller levels to graduate to real estate investing and borrowing from major banks and institutions. And so you need those data points for a period of time. You need to finance a car or two. You need to finance a couple personal and unsecured loans. You actually can do this very effectively without going into debt. That's what he's referring to, is not going into debt. I understand that, but you do need data points and you have to build them by borrowing. So hopefully that makes sense. Point number 3, stop seeking financial advice from branch employees that are not licensed. Okay, his point was if it's a licensed professional, licensed financial advisor, then they're great. You can listen to them and let them help you develop how to invest your money in the stock market and build your wealth. But when you walk into the bank, the general at the desk, bank employees, the bankers that are at the desk, are not the people you want to turn to. And his elaborate point behind that was that banks are not incentivized to teach you how to be financially literate and educated, because that will lead to you pulling more money out and investing it and using it in ways that doesn't allow the bank to keep those deposits and lend out and make a profit. Okay, that's a lot to break down, so I'm going to try to break it down as fast as I can, but efficiently as I can. First off, the licensed professional advisor that's going to be in a bank branch or accessible through your financial institution is partnered in conjunction with the bankers at the desk. Even though some banks don't license their bankers, at some banks they do. That's another point in itself. You may be already banking at an institution that does have licensed bankers. So that's the first thing. The second thing is, even if they're not licensed, they're typically trained enough and knowledgeable enough to be able to help you with your finances, to refer you to a licensed professional. You otherwise are going to have a lot of financial education on your own to walk in and deal directly with a financial professional and effectively build that relationship without going in the dark. That banker is the midpoint, is the median of financial education and financial resources until you're in a position to effectively invest and sit with a financial advisor. Many financial advisors won't even work with you until you have a certain amount of assets, $50,000, $100,000 in net worth or liquid cash. They won't even touch you because you're too far down, the totem pole financially to be talking about investing. That's where your banker comes in. That's where they're teaching you budgeting and budgeting tools. They're teaching you effective spending and saving habits. They're teaching you how to manage and fundamentally build your credit. Decent bankers are trained for these things. They're the median for you to get to the financial position you need to get to invest. So yes, I understand what he's saying, but that's the first part of that. The next part about banks not being incentivized to educate you financially. That's a two-pronged, yes, banks want deposits. They need them in order to lend out and make a ton of money. That is a fact. Do banks probably enjoy the fact some people leave large lump sums unproductively in their checking and savings? Of course, I'm sure they do. But at the end of the day, the idea that banks are not in the financial education business is insane. And I got to just say it straight out. Banks need you to be somewhat financially savvy and effective and prosperous in order for you to be a strong, profitable customer for them. If you're financially illiterate, that means you don't know how to manage your money. You don't know how to, balance a checkbook. You don't know how to, not overdraw your account. You don't know how to save effectively. Then you're not a healthy customer for the bank. You default every time you get a credit card or a loan. You're defaulting. If you're financially illiterate, you're a risk to the bank. Now, the bank's not going to go out and teach you how to get rich off crypto or a massive rental portfolio maybe, but the bank is incentivized to give you at least a fundamental foundation on financial education. They need you to be financially literate to an extent, not to mention that the financial education space is a business in itself. We're not talking about banking 50 or 70 years ago, where it was just a deposit in and out, like the bank teller was the bank employee and the branch managers. We're in a different era now. Banks are all over the financial system now. Many banks are partnered with investment firms. So when you invest, they're still winning. If your money comes out of savings or comes out of checking and goes into an investment firm that they're partnered with or under the same company umbrella with, they're still earning money. They're still winning by helping you build your wealth through fees and other services provided through that investment platform. So banks are definitely incentivized to have you financially educated and to help you get wealthier, because this is another point. I'm gonna round this out and I'm gonna try to close this out. Banks, when you are a small customer, we'll say somebody who only has hundreds or a couple $1,000s in the bank, you are not keeping the lights on at that bank. It's not that you're not a value customer. I'm not trying to crap on anybody, none of that. But at the end of the day, you are not keeping the lights on and payroll going at that bank if you only have a few $100s or $1,000 at that bank. Clearly the banking system is a beneficial relationship on both ends in order for the bank to even get you to deposit money. You're now making the point, or the point he made, is if every wealthy person who has 6 and 7 figures tied in the banking system is an idiot. Like, at the end of the day, these people didn't get to this position and have all this money in the bank for no reason. Clearly, this relationship is profitable on both sides if you're strategic and know what you're doing. So wealthier people are the ones really keeping the lights on and payroll going and profits going for any bank and institution. It's people with higher balances, 5, 6, 7 figures and beyond, that are really making the bank profitable and keeping the lights on. It's not the people at the bottom overdrawing their accounts, charging off credit cards. That's not the ones keeping the lights on. This idea that banks are like feasting off of poor people and that's how they're so rich is semi-preposterous in a sense of speaking. That's not where banks' bread and butter typically is. They're making way more money off of a wealthy client, somebody with 6 and 7 figures in deposits that also has 6 and 7 figure mortgage loans and 2 auto loans and an RV loan and investment brokerage account with them, getting their insurance products through a company that they're partnered with, so on and so forth. Relationship banking is where the real profit is for financial institutions. Yes, they make money on fees. Yes, they make money on people who are financially illiterate. But banks make money off of with wealthy people. And if you want to also become a wealthy person, you also need to master relationship banking. I'm gonna cut this video off roughly at this point. I might even do a part 2 because there's so much to break down in this. But I think he did a great job making this a great talking point and turning people's light bulbs on to the idea of being serious about their banking relationships. I do agree with him there. He is a retired branch manager, I believe, from like Bank of America or somewhere in commercial banking, if I'm not mistaken. I am an active banker at a pretty decent sized institution and a financial professional licensed in several different ways. I'll drop some of that info down in the links. So we're both qualified to speak on this topic. Thank y'all for tuning in. I know this content was valuable for you. I appreciate it bringing it to you. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.